Today we want to talk about residential financing. We want to learn chapter 9, 10, and 11 together. And next slide. We have 4 sections here. The first section we want to talk about legal foundation, about residential financing, what kind of a legal document would need to be prepared. And then we want to talk about mortgage product, the loan that allow us to purchase residential property, such as like a home, and what type of mortgage products are there. And then we want to talk about the primary market, and then followed by secondary market. So we have 4 sections here. Next slide. Mortgage loan, in terms of the legal foundation, whenever a mortgage is created, there are 2 documents will be created. The first document is called the note. The second document is called mortgage. The note is a financial contract, detailed financial rights and obligation between the borrower and the lender. And here we have terms of the financing will be spelled out, such as, for example, interest rate, the number of a year for this particular loan, and etc. So those kind of information will be contained in the first document. The first document, we call that note. The second document, we call that mortgage. Mortgage is a financial contract that pledges the property as a security for the debt. So mortgage simply is a piece of the document about the use of collateral, and collateral is the property itself. For example, if I want to buy a new home, I want to apply for a home mortgage, and the home that I purchased will serve as a collateral. And if down the road I do not pay my monthly payment for a certain period of time, then I will get into trouble, and the bank may want to seize the property and foreclose this property. Then this property will no longer belong to me. And about the use of my home as a collateral, those kind of the legal right and obligation will be spelled out in the second document. We call that mortgage. Next slide. On the first document, the note, a very important piece of information in the first document note is about the interest charge. And so here we're talking about interest rate, and we're talking about that at what time you need to pay those interest expenditure, and also the determination of interest rate as time go by. So those are kind of key information would be spelled out in this part of the note. And interest rate can be either fixed or variable. Fixed just means that at the time when you sign this mortgage, this particular loan, you know exactly what amount of interest that you will need to pay. And this interest amount, this interest rate, is going to be fixed as time go by. And that's why we refer to fixed interest rate. And there is another type of the mortgage. The interest rate would be fluctuate, would be floating, along with the interest rate market condition. When the market interest rate goes up, okay, and we have a higher mortgage rate. When the market interest rate comes down, we pay less amount of interest expenditure on the mortgage. So we have these 2 different type of the interest rate. And the monthly interest rate, okay, will be simply the annual stated contract rate divided by 12. So the interest rate that we obtain from a bank, let's assume 6%. Okay, if say that the annual rate is 6%, then monthly rate will be simply 6% divided by 12. So that will be 0.5%. In other words, that every month we will need to pay 0.5% of interest on the previous balance. Okay, and the actual monthly interest charge would equal to the monthly interest rate. Okay, that would be the annual interest rate divided by 12 time the beginning of the month balance, that will be end of the month balance from the previous month. So let's take a look at this numerical example. Suppose that the contract rate, the mortgage rate is 6%, and the balance on the first day of the January is $100,000. We still owe the bank $100,000. Then the interest for this month, for January, would be simply 6% divided by 12. That would be monthly rate, time the beginning of the month balance, $100,000. So after this computation, as you can see that for this month, the January, there is a 500 interest expenditure. And this is payable on the first day of the next month. So that will be February. And usually that the bank will give about 15 days of a grace period, because when you cut a check and mail it in, it takes some time. So the interest charge for the month of January will be due on the first day of the January, and the check ought to arrive by the 15th of the February. Next slide. And the adjustable rate, okay, and we call that, this type of mortgage, we call that ARM. That will be adjusted rate mortgage. And it's quite popular in the residential loan market, particularly used by investors. Those people who purchase a home with the expectation that they are going to sell the home in the near future. Let's say that in 2 or 3 or 4 years, instead of holding this home and living there for a long period of time. Okay, and the ARM is quite popular among those professional investors. And the interest rate for ARM has 2 components. The first component is the so-called the index rate. The index rate, the popular index rate would be is 1-year T-note rate or the LIBOR. Those are popular interest rate that one would be able to find on the internet, and those rates change every second, every day. And then the second component of the ARM interest rate would be the so-called spread, or sometimes we call that ARM margin. Okay, and it just means that additional rate of return that the lender would need to earn above the index rate. That would be either 1-year T-note or LIBOR, because 1-year T-note or LIBOR are more close to the so-called risk-free rate. So the margin reflecting the amount of underwriting risk associated with the borrower. And this spread, usually, historically speaking, is about 2.75%. And today, okay, today this margin, okay, today is about 0.5% higher than the historical average. So today it's about 3.25%, the spread, because right now we are living in a very uncertain era, and there's a lot of risk out there. So the bank, when they're underwriting an ARM mortgage contract, they would request a much larger component of the risk premium. This is a risk premium. Right now, today is about 3.25%. And how about the risk-free rate? That's a 1-year T-note rate. Okay, and 1-year T-note rate nowadays is very, very low. It's only about 0.15, 0.2%. So you add that to the 3.25, so the ARM rate today is about 3.35%, 3.4%. Okay, so that's the kind of interest rate today when you borrow an adjustable rate mortgage. And whenever there's a change in the interest rate, surely that the index rate change, and therefore the overall ARM's interest rate will change. Okay. And the mortgage lender usually need to notify the borrower at least 30 days in advance when they change the interest rate because the market index rate fluctuate as time goes by. Next slide. In the first document, the note, okay, in addition to the information about the interest rate, okay, and they also contain information about caps. That would be the the maximum amount of adjustment, okay, for the arm contract. For example, one type of the cap is the so-called periodic cap. I mean that usually a period is 1 year. That you allow the change of the interest rate. That would be about occur like once a year. Usually, that would be the most popular frequency. So from 1 year to another year, there is a maximum amount of the interest rate change that this contract will allow. So that's why we refer to periodic cap. An overall cap just means that for this entire life of the arms contract, that to what extent that the change of the interest rate would be permissible. That's why we refer to overall cap, not just year-to-year change, but we're talking about for this entire life of the arms contract. And by the way, the most popular length of arm contract is 5 years. 5 years being the most popular contract. So you can borrow arms and then you can borrow for 5 years. And that is the most popular maturity. But the market also have available kind of different maturity, such as like 3 years, 7 years, and 10 years. Those are all possibility, but 5 years being the most popular arms maturity. And teaser rate. Teaser rate means that usually for the first year there is artificially low interest rate, and kind of providing us an incentive for the borrower to use the arms rate, and that's what we refer to the teaser rate. And this is a temporary reduced interest rate, very much like when you apply for your credit card. Usually the credit card company will give you a special rate for the first year. Same thing here. This is a special rate, but only for usually the first year. And then we have a possible kind of cap. That would be the payment cap. It just means that what would be the maximum amount of the monthly payment that this loan could possibly become, regardless of how high the future index rate would be. And that's why we refer to the payment cap. Next slide. And in terms of payment, okay, most standard fixed rate mortgage, okay, are level payment. That means that every month we pay exact same amount, and that gives the borrower a lot of cash flow certainty. And also they are fully amortizing. Fully amortizing means that at the end of this contract, at the end of the maturity, we pay off all of the principal. So as time goes by, the principal kind of coming down. At the end of maturity, we pay off all of the balance. And for this kind of standard fixed mortgage, and we call that level payment mortgage, the most popular maturity today is 30 years. So a lot of home buyers today, they use 30 years level payment mortgage, and the interest rate would be determined at the time when you sign this contract, when you borrow money. Therefore, every month you pay exact same amount of payment. And if you indeed own the home for 30 years, you pay your payment 30 years. At the end of the 30 years, basically you do not owe the bank anything anymore, and you own the home 100%. That's why we refer to this type of leveraged payment mortgage. And in addition to the standard loan that are fully amortizing, there are loans out there. They are not fully amortizing. They can be partial amortizing, or even zero amortizing or negative amortizing. What does that mean? Partially amortizing means that at the end of maturity, because you don't pay whole lot of interest every month, therefore at the end of the contract you still own a large lump sum of the partial principal. Okay, and this relatively large amount of the final principal liability, we call that balloon. So there is a balloon payment at the end of the contract, and this kind of loan is what we refer to partial amortizing. And there are loans, there are zero amortizing. They just mean that every month we only pay interest payment. we do not pay any principal partial reduction. Okay, and because we do not pay, we do not pay down any of those principals. So at the end of the contract, we still have the entire principal outstanding, and that's what we refer to zero amortizing. And when the housing market is really crazy, when there are lenders that are not really responsible, sometimes they come out with a mortgage such that the monthly payment is even lower than the interest payment. Therefore, the unpaid interest pile up the principal, making the principal balance higher and higher as time goes by. And that's what we refer to negative amortizing. And of course, after financial crisis of 2008, that in the market we rarely see this kind of negative amortizing kind of instrument, because it's just irresponsible. Okay. Next slide. And this is a typical profile of the standard level payment loan. And this example is for 30 years. So if you look at the if you look at the x-axis, we have 30 years here, and the black color representing the amount of the principal. That would be the loan balance. At the beginning of the contract, the balance is 80% of the home, and that's a typical amount for the maximum amount of money that the home buyer would be able to borrow. You would need to have 20% of the saving as a down payment, and then you can borrow at most 80% of the home as the traditional mortgage. So at the beginning you have 80%, starting with 80% balance, and as time goes by you pay down a little bit of the principal. Then toward the end, as you can see, that you come down much faster at a higher slope, because toward the end, let's say the starting, particularly around like the starting years of the 15, 17 years, then because your balance becomes smaller and smaller, so every month the payment that you pay more go to the reduction of principal and less go to the interest payment. Okay, and that's the reason why that we see a quicker reduction in the principal in the later half of this 30 years mortgage. Next slide. And in the note, this particular document, okay, we also see quite a lot of this loan term. And for example, the number of years to maturity would be specified in this contract. That usually is expressed in the number of the years. And if this loan is partially amortizing, then the amount of the final principal repayment, that would be the size of the balloon, okay, would be specified, okay, in this particular contract. And when we have a balloon loan, and it would provide information about the number of the years that will be used for amortizing the loan, that would determine monthly payment. And also, if it's a balloon loan, it would specify in what year that this loan is going to get terminated. Therefore, the final principal repayment is going to occur at that time, and that will be well specified in the contract as well. One possible example is that this loan will get amortizing over 30 years. The larger number of the year that you allow for amortization, the monthly payment will become smaller and smaller. So you use like a long horizon for amortization, such that to bring down the monthly payment. And this loan will not last for 30 years. Maybe it's a 10 years mortgage. Okay, so every month you pay relatively small amount of the payment. At the end of the 10 years, you still have a large lump sum of outstanding principal. then this would be the balloon payment that you would need to pay off at the end of maturity. So for balloon loan, there will be information about the number of years for amortization and also the number of years for the maturity of this particular contract. And balloon loan is not popular for residential financing, but it is very popular for income generating property financing. So if I own an office building, if I want to apply for a mortgage, then there's a good chance that that mortgage will structure as a balloon loan. Okay, and we will talk about why this is the case. Okay, when we move on to the mortgage calculation topic. Next slide. And in the note, this particular document, we also might be able to find the information about the rights of prepayment. What does it mean by rights of prepayment? That means that whether you are able to prepay the loan before the maturity. Let's say that today I buy a home, I apply for 30 years level payment mortgage, but I do not own this home for 30 years. Let's assume that 3 years later I get an even better job, I will need to move to a different city. Am I be able to sell my home in year 3 and then pay off this entire loan? And the answer is that for residential financing, okay, the answer is largely yes. The majority of the standard residential mortgage that the federal law mandate that the homeowner has a right to prepay, and the bank cannot penalize the homeowner to sell their home. Okay, but this is not the case for income generating property. When I buy an office and I apply for a mortgage, let's assume that this mortgage has a life of 8 years. And it's often the case that in this particular contract, the lender will say that I cannot do the prepayment in the first 4 years, for example. And if I wanted to do the prepayment in the first 4 years, then there might be a penalty or simply just not possible. So this kind of the contract design is quite different between the residential mortgage versus the commercial mortgage. Next slide. Late fee. If you do not pay your monthly payment on time, surely that there will be a late fee. Very much like when you have a credit card loan, if you do not pay your minimum payment on time, then you are going to receive a penalty notice from your credit card company. So same thing like here. So when we talk about that, the first date of the month would be the first day of the month would be the due date, and you have about 15 days of the grace period, right? And if you pay too late, then usually there will be a 4 to 5% of the late payment for that monthly payment. Okay, so that's quite substantial. If you're late, then there will be 4 to 5% of penalty. Next slide. And in the note, this particular document, it also talks about what kind of personal liability that the borrower would need to incur, and for residential financing, and usually that the borrower has a personal liability. And here is that in addition to the home that uses collateral, if the home in the event of foreclosure is still not sufficient to pay off the lender's money, then the lender might go after you for your other asset. That is a possibility. It all depends on individual circumstances. It may or may not be. Okay. And on the other hand, if this is a mortgage for a commercial property, then there will be no personal liability in general. So again, residential property, residential financing versus commercial financing, we often see differences in terms of the personal liability. Next slide. the mortgage, the second document, we call that the mortgage. The mortgage is a document outlining the right and obligation of the borrower and seller and regarding to the use of collateral. So the mortgage basically convey to the lender a security interest in the mortgage property, and that's what this document is about. And this document, the mortgage, gives the lender the right to rely upon collateral as a last resort in case that the borrower do not pay the monthly payment. Next slide. In this document, usually we find the following clauses. The first one is a description of a property, because it's a legal document. We say that, oh, this home has a lot number, blah, 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 and home address this, and who is the borrower, etc. We have those kind of information. The second clause is insurance clause. Okay, and because collateral is a source of the protection for the lender, so lender care a lot about preserving the value of the property. And for this reason that they will ask the homeowner to purchase insurance. Make sure that the home has the value, okay, in case that the bank will need to seize the property. So the insurance, you need to have the hazard insurance in case that the home get burned down by fire. And there is an insurance standby to pay for the damage, instead of having the homeowner escape and then dump this burned property to the bank, and while the bank suffered the loss. So the bank are not stupid, right? The bank will need to think about protecting the value of the collateral. So a very important part of this protection is make sure that the homeowner purchase and pay for the home insurance. The third one is the escrow clause. Escrow clause is accounting account. Is an account that through which that for example, insurance premium would be paid on time, the property tax would be paid on time, etc. And the reason is that if the property tax is not being paid on time, the local government has an even superior right than the lender to seize a property and foreclose a property to get the property tax back. And so the lender worry about this. The lender want to make sure that if you want to borrow my money, you had better pay your property tax on time. If you do not do that, then I want to seize your property as soon as possible. So we have an escrow clause mandate the establishment of the escrow account, and then all of those money like tax, insurance premium will be paid on time. Next slide. The fourth clause is acceleration clause. So when this particular legal term is trying to enable the lender to seize the property, to auction off the property when the borrower do not pay money in a certain fashion. Okay, so that would be one of the clauses allowed the bank have this legal foundation to do the foreclosure and the auction and the sell the property to recoup the money that had been lent out. And the fifth one is the due on sale clause. What this means is that, let's say that I borrow a 30 years fixed rate mortgage. 3 years later, I get another job in a different city. I will need to sell this existing home. When I sell this home, I would have to pay off all the remaining balance with this mortgage right away. I could not simply say that, oh, I borrowed this loan 3 years ago at such an attractive mortgage, and I wanted to keep on using this low interest rate loan, and I would not want to pay back the money. No, you cannot do that. Okay, when you obtain a mortgage to buy a home, that loan is specific for this particular property. Therefore, when you sell this particular property, you will need to clear this loan with your initial lender. And that is what we refer to do and sell clause. And then the last clause is about protection of the property, like the hazardous substances clause and preservation and maintenance clause. And here, this clause that the lender would say that in your home you cannot do anything dangerous to the value of property. For example, you cannot raise marijuana in your home, something like that, because that would damage the value of a home and it's dangerous to the property. And also that the maintenance that if there is a major damage to the home, then you will need to prepare for it. Otherwise, for example, if a roof disappear by a strong wind, and you need to put back the roof. Otherwise, the water keep on leaking. It's going to damage the floor. It's going to destroy the value of property. So a certain level of maintenance is expected, is required by this second document. We call that the mortgage. Today, let's stop it here. Next time when we come back, let's continue talking about the default, and also that will be the second half of this topic. See you.